Hi, everybody. Great topic today. When do you need safe investments? Okay. I talk about this quite a bit in a lot of my classes. It's important that we understand everybody does not need safe investments. Okay. Need is different than want. Plenty of people want safe investments. They don't like the stock market. Totally understandable. Not a big deal. You can have safe investments. They're a little boring sometimes. They don't earn as much sometimes. When your buddy on the golf course is telling you that he just made 80% in the stock market over the last few months, that's all wonderful to hear. But some of us don't necessarily need that adrenaline rush in retirement. Totally understand the want side of that. But we need to understand the need side of this. So that's what we're going to talk about today. Let's start with my math, the math that everybody needs to understand. Why investing in retirement is different is because of math. Okay. What worked in our growth and wealth building years is not necessarily the same thing that works for people in retirement. And that is very simple math that proves this. Okay. So let's talk about volatile investing. Okay, I think we can all admit that there's volatility in our stock market. Sometimes it's up, sometimes it's down. Yes, over the grand scheme of things, it goes up and up and up, but we have to deal with the turbulence in the meantime. So let's talk about that volatility. If you had $100,000 and you picked an investment, you threw it all in a mutual fund, and that mutual fund crashed and went down 50%. And I exaggerate the math so we can see the difference here, okay? So you had 100,000, you lost 50%, now you only have $50,000. What happens if you earn the same 50% back? So down 50%, up 50%, how much money do you have? Well, some of you might go cross-eyed because you only have 75,000 back. Okay, and this is that math problem that we have to understand. Earning 50% on 50,000 means you only earned $25,000. Okay, if you earned 50% on $100,000, you earned $50,000. It's the same percentage, but it's less dollars because you earned it on less dollars. That math is what your brain has to make sense, because it's so important when it comes to investing and for people as they head into retirement. So let's create a baseline here. If you took no money from this portfolio, you had $100,000, you lost 50%, how much do you have to earn before you have your $100,000 back? So to go from 50,000 to 100,000, you have to earn 100%. Okay, so if you lose 50%, you have to earn 100% before you break even. Doesn't seem fair, I know. So when you're in your wealth building years, all of the advisors, all of the magazines, everybody says, well, you got to keep investing through that turbulence. It's a buying opportunity. All those mutual funds and stocks are on sale. Buy more, keep putting in, dollar cost averaging. There's all these wonderful little phrases and things that try to get you motivated to keep putting money in. Well, there's a math reason why that actually helps, okay? So now what if you put 10,000 into this account? So you had 100, you lost 50%, you have 50,000. You put 10,000 in because it was on sale, it's a buying opportunity, I'm gonna buy more. Put 10,000 in, you got 60,000 in the account. But to keep this apples to apples, you've invested 110. So you've got to go from 60,000 now to 110 to break even. And then after that is when you build your wealth. Well, guess what happened? Now you only have to earn 83%. Okay. Now I don't expect people to do that math in their head. Totally understandable. You can guesstimate it somewhere around 80%. It's 83%. But what I do need you to see here is, did you help yourself by putting $10,000 in? And the answer is clearly yes. You only have to earn 83%. to break even versus having to earn 100%. So by putting money in, you're helping yourself recover because your future earnings are on more dollars and you have more shares. And once you break even, that's when you build that wealth. You have more shares, all individually growing, everybody's happy. Okay? This is why the principles of investing when you're building wealth work. It's math. What happens when you transition to retirement, though, is different. So now we have this $100,000 account. We lost 50%, and now we take 10,000 out. Okay? So we had 100, we lost 50%, we took 10 out, we only have $40,000 left. But hey, now we only have to earn enough to get back to 90. So we've got to go from $40,000 to 90,000 to break even. Before we start making up for what we've taken out, we got to break even. Okay. So 40,000 to 90,000. And now all of a sudden we have to earn 125% just to break even. So then we can start earning to make up for what we took out. We exponentially made things worse. We dug ourselves into a deeper hole. And we are retired. What are the chances we're going to earn 125% before we take our next withdrawal? Slim to none, unless you're just not going to spend your money in retirement. We can't live this way in retirement. And yes, these are big numbers. 50% is a big number here. But this happens when you do 10% loss and you pull out. You just dug that hole deeper. You have to earn even more. We put 10,000 in, we saved ourselves 17%. This is exponentially worse because now we took 10,000 out, we cost ourselves 25%. The effect of volatility on your portfolio through withdrawals will destroy your portfolio. If your IRA is in required minimum distribution phase and you actually pull that money out and use it, you cannot have a volatile portfolio. You have to have a plan to pull from somewhere that has not lost money when the market's not doing well. Okay? It's very important. So hopefully you're starting to see why someone might need safe investments. We need safe investments when we're choosing to withdraw. If that black and white math hasn't shown you enough, here's that black and white math working. Okay. So the baseline, we're just going to put 100,000 in and we get to pick an investment. We got the red investment, the green investment, or the average of both these investments. The red investment is the S&P 500 from 1990 to 2010. The green investment is from 2010 back to 1990. It's still the S&P 500. It's the exact same returns in the opposite order. So 12% is up here when 12% is down here, -4, -4, everything in between. It's all reversed. Okay. So same returns, opposite order. And then the average, kind of like a mutual fund says it averages 6 1/4. If these were mutual funds, they averaged 6 1/4. Both of them did. Okay. Now, if we're in our wealth building years or we're in our preservation years, we just put money in, all of these are going to end up in the exact same place. They're just going to take different paths. Okay, this is why mutual funds represent themselves with average returns over 1 year, year to date, 5 year, 10 year. They show you those. Okay, and we tend to judge how good that mutual fund is based on those average returns. But then you go to retire and we plan on taking money out of that portfolio. In my example here, we're taking 6,000 out every year along the way. So we put 100,000 in. We have the same investment choices. Okay. The S&P from 1990 to 2010, the S&P from 2010 back to 1990, or just an average of 6 1/4. Okay. Well, these should all end up in the same place, but they don't. Okay. The day you take money out of any portfolio, you can throw out the average. It means nothing. You've changed the math. The average is not applicable in any way, shape, or form. You could tell me it averages 25%, and it means nothing to me. You could tell me I have a 25% average or I have a 6% average. Which one's better? And I can't answer you because the average is meaningless. 25 is not better than 6 if you're withdrawing money. It might be better, but it might not be. Okay? That's the scariest thing about this. You can't rely on these averages. They mean nothing. This is earning 6.25%. Okay? The order of returns now matters. When you choose to start withdrawing, if you withdraw and take a hit, your 6% withdrawal rate, because 6,000 from 100, 6,000 from 100 is a pretty big withdrawal rate. That's 6%. But notice the red line, we hit a great run in the market. Built our portfolio up to 250,000. Well, 6,000 out of 250,000 is a very small percentage, and the portfolio actually keeps up. But we hit turbulence right off the bat, and we keep pulling that 6,000, the portfolio falls apart. You hit turbulence early, you're in trouble, period. If at any point, if we adjusted it up to 6% of 250, you're going to see this thing plummet and fall apart. So I didn't adjust. I just took 6,000 every single year. But if you get here and say, oh, we can pull more. Look at our portfolio. It's doing wonderful. Let's start pulling more. And you keep pulling, and you'll watch that portfolio fall apart so fast you wouldn't believe it. Withdrawing through this kind of turbulence is so scary for these portfolios. So, a couple of things. Order of returns matters when you start withdrawing. Averages mean nothing when you start withdrawing. Which is better, 3% or 7%? Well, if we're depositing money to further this point, the average of 7% is better than 3%. Period. We just deposited, we're not withdrawing in this case. Averages tell you the truth. Okay? Now, we go to withdraw. Which is better? Boring 3% or 7%? Which one's better? Strangely, the 3% blew away the 7%. So who needs safe investments? Who needs them? People that need to pull their money out. So here's your mantra. The higher your dependence on your portfolio for income, the less it should be left to chance. The larger your withdrawal rate, the greater the effect of volatility. Deposit into volatility to build wealth. Withdraw from stability to maintain it. This is what you have to live by when it comes to retirement. Okay? Not everybody needs safe investments. I meet people all the time. They have enough Social Security and pension income to pay all their bills and enjoyment. Those people don't have to have safe investments. Now, when you get to required distributions from your IRA, you should have a plan. You should have investments that don't go down. People unfortunately discovered this year that bonds do go down in value and had a hard time finding a place to pull their required distribution. Bonds are not a good idea, okay? They go down in value as interest rates go up. In the United States, economics says if we see inflation, interest rates are going up. So I don't want retirees losing money when we're seeing inflation. For that alone means no bonds in a retiree's portfolio. Unless you're just buying an individual bond and holding it till maturity, there's no reason to have a bond in your portfolio for that reason alone. Now, there's plenty of other reasons, but that's a good enough reason to just move on from there, okay? So let us know if we can help in any way. Always shoot us an email with any questions or concerns, or if you want to meet with me for any reason, we're available nationwide via this wonderful Zoom application that has come out during the pandemic, or give us a call, 800-345-3155. Again, this YouTube page is wonderful. We keep putting new videos in there. Subscribe, like, share it. This is how this world works. We've got to get all these subscribers up so more and more people are aware of the education that we're putting out there. Again, thanks a lot. Please, again, like it, subscribe, do what you got to do. Keep coming back. I'm uploading at least 3 or 4 videos every single week. Thanks again, everybody.